What's up, everybody? It's Wednesday, July 20th. Pretty hot here in New York, about 98 degrees. I got myself some ice water. I like the hot. I'm a hot weather kind of guy, so it doesn't bother me, but I know a lot of people are suffering in Europe. They're hitting record temperatures, and they don't have air conditioning over there. I lived in Europe for 10 years, and I remember going to the office, and it was sweltering hot, and I worked in a big bank, and there was no air conditioning, and I was just like, how do they handle this? I don't know, but and they say, oh, it doesn't get hot here, but it did, even back then when I was over there back in the 90s. No air conditioning. Anyway, let's talk about the markets. We're up again today. So, yesterday was a positive flow day, 7 billion positive. Today was a positive flow day because we had the Social Security payment. I don't have the numbers on that, but you know, the last Social Security payment on the 13th, that was like a 25 billion positive flow. So it's good. So between today and yesterday, figure around a 32 billion positive flow. That erases the 21 or 22 billion, the 22 billion drain we had the previous day. What was that? Monday, I guess. So let me break it down for you. We are currently about 62 billion away from recovering the April tax strain. I have to be honest that this recovery has been really slow, and I said that was going to happen. Yeah, I said way back that was going to happen. The good news in July so far, July we only had so far 3 negative flow days. That's not bad, because in June we had 11 negative flow days. So June was brutal, man, and April, May was not so great either. So April was terrible with the 325 billion tax drain. May we eked out an 86 billion deficit, so we started to recover some of that. June we only had a 54 billion deficit. That was because we had 11 days of negative, 11 days of drain. I mean, that's like half the month. And this month so far we have only 3 days of drain, and we're doing about a let me see if I remember, about a 120 billion deficit. So that's good. I mean, the deficit right now is as good as it has been since February. But we're still 62 billion away from just recovering what happened in April. Now, I've been saying we're going to get there. You know, we may not get there this month, but we'll certainly get there by mid-August, because mid-August, again, has the quarterly interest payment. That'll be 45 billion. The other thing that's a little bit concerning to me, well, there's two things. Number one is so far in July, even though it's been good in terms of the number of net positive flows, right? Like I said, we only had 3 days of drain. That's good. But the leading flows, in other words, the leading spending flows right now, as of yesterday, we are below, we're like 70 billion below where we were in June. So that's a little bit, concerning. It puts us on a track below, I think well below June. What do we have in June? We had like a 574 billion, if I remember correctly, a 574 leading flow in June. So we're like just brushing up on 500 billion. We might even be below that. I don't know. So that's a little bit worrisome. And the other thing is that I just looked at the 10-day average of daily flows, and that really broke down. I mean, we have broken down. That started to break down at the end of May, And I thought it would recover at least some, but it's just now it's just like trending down, and we're trending on that projection. If you look at the 10-day average of daily spending, I mean, that's like projecting 370 billion a month. I mean, that would put us below the pre-pandemic average. I mean, now, you know, the pre-pandemic average monthly spending, government spending, was like 420 billion. I mean, that would put us well below. And that's not good. All right, so hopefully with next month's interest payment, and if these flows pick up a little bit, we stabilize. I think if we stabilize, you know, that's fine. As long as we stabilize, I mean, it could be at a lower level. Obviously, the economy is reflecting that in terms of economic growth. We're going to have a negative print for the second quarter, you know, but if it stabilizes, you know, then things adjust. Things adjust to the new rate of economic growth. Right now, there's no growth. It's negative. Second quarter growth is going to be negative. Let me talk a little bit about inflation, because somebody posted a comments, you know, when I came out with more or less a bullish outlook, because the flows were recovering and we were recovering that April tax drain, and I've been talking about that and I've been correct about that. Somebody said, oh yeah, Mike, we're just supposed to forget about the inflation like it doesn't exist anymore. No, I never said that. First of all, historically, stocks tend to be a good hedge against inflation. And there's a reason for that. That companies see their pricing power go up. So it may not be an across-the-board thing. There's certainly going to be industries and businesses that get hit. But we have seen it, particularly in the commodities and the materials sector and the energy sector, where pricing has, you know, improved dramatically. The problem that I think a lot of you guys have, and it's not a criticism, you know, it's just natural. When I say this, it's natural. It's like we look at things through the lens of our own experience. So like when we have to go to the grocery store, or when we have to, you know, fill up our gas tanks with gas, and it's costing more money, then the natural inclination is to say it's a negative. Okay, we don't consider, you don't sit there while you're paying for your groceries, and you don't think when you're paying for your gasoline, hey, what about the gasoline producer? What about the food producer? You know, they're the ones who are getting the higher payments. I've had this conversation, or I've spoken about this many times in the past. And again, this is not a criticism. I understand this, that people just naturally tend to look at the situation through the lens of their own experience. You know, it's the same thing like with savings. Like people say, well, I save money. You know, why doesn't everybody save money and then the savings rate will go up? No, it doesn't, because my savings equates to less income and savings for someone else. In other words, if I don't spend, that was spending that would have gone somewhere to somebody else's, you know, business or bank account or whatever. So it's a fallacy of composition. We can't all save at the same time and expect savings to go up. Somebody has to net spend, or some entity has to net spend in order for the other person or the other entity or us in the aggregate for our savings to go up. That's why when the government runs deficits, it spends more than it takes away in taxes, and we are the recipients, not equally distributed, obviously, but the economy, the non-government, everything that is not the government, sees an increase in their financial balances. And it's the same thing with inflation, and it's the same thing with deflation, all right? Deflation is the other side of the coin. When prices go down, It may be good for us for consumers. And again, we look at that through our own experience. Oh, this is great. Look, prices have come down. I can afford to buy more, whatever. But for those who are selling, for the producers, they see their incomes go down. So you have to understand what is inflation and what is deflation. They're two sides of the same coin. It's simply income redistribution. So to just generalize and say, oh, that's negative for the stock market, where inflation, oh, we're just supposed to forget about that. Look, I understand, and I'm not saying inflation is going away anytime soon. First of all, the very fact that the Fed is raising interest rates, that raises inflation too, because the cost of credit is reflected in the cost of all goods and services. When they raise the interest rate, prices go up, and the general price level goes up. It's something that, you know, central bankers and just mainstream economics, they have this completely backward, but that is their, you know, that is the way they think. That is their mindset. That is their orthodoxy. Okay, so they stick with that. But stocks, I'll say this again, stocks historically have been a good hedge against inflation. You just have to, you know, be a little bit savvy to position in the right sectors of the economy that are going to benefit from inflation. And then you can protect yourself. I mean, a lot of this game is just about, you know, preserving capital. And really, it's about knowledge. It's about information. I mean, you could throw your hands up in the air and say, oh, you know, I'm screwed, man. There's nothing I can do. But that's because you don't want to understand the dynamics. If you take a little bit of time, and this is not rocket science, it's not, you don't got to be Einstein. You're not figuring out quantum mechanics. I mean, just understand the dynamics of what is happening. And that gives you opportunity. So I had to mention that because it's very important. It's a very important thing to understand. Okay? Stocks are a good hedge against inflation. You have to understand how inflation works, just how you have to understand how deflation works. Just because you are not in a position personally, or let's put it this way, just because you are seeing the impact of inflation as a negative thing on you, doesn't mean it has to play out that way necessarily, if you understand what I'm saying. Again, you could take advantage of that. All right? All right, so let's get back to the markets. So I think today, the good thing, again, let me say, we only had 3 negative flow days in July. That's good, compared to 11 in June. We got up today pretty easily, I should say, through my short-term resistance level of 39.50 on the S&P. That's the September S&P futures. Tomorrow, we're going to have an ECB meeting, and they're expected to raise rates. I think I mentioned this yesterday. They're going to raise rates. It'll be the first rate hike in 14 years. They're going to go 25 basis points. I happen to think that's going to play out as a negative for the euro. I think the markets might get a little bit spooked from this. You might see a pullback. But again, I am advising that you buy these pullbacks. The other thing going on is Mario Draghi, who's he's about to get kicked out over there in Italy. And that probably will create some bearish sentiment towards the euro as well. The euro had a couple of days now where it popped back up. We got down below parity. It was like 99.5 cents to the US dollar. It's back up to like, well, today it was like 101.70. I think we got as high as 102.70, and it backed off. ECB raising rates, I do not see that as a positive for the euro. I see that as a negative for the euro. I do not think that the euro's downtrend is over. I think they got some major energy issues because of the sanctions, because of what's going on with Russia and the war, and the posture that Europe has taken towards Russia with regard to energy imports. I mean, all that stuff. I don't think we have seen the culmination of the negative impact from that. So maybe a couple of days now of turbulence. Next week, Wednesday, we have another Social Security payment. I think I mentioned that. That will round out the week. What is it? So next Wednesday will be the 27th, 31 days. So 28th, 29th, 30, 31. So Monday will be August 1st. Not this coming Monday, the following Monday. And then again, August 15th, right around August 15th, we get the quarterly interest payment. Things look good. I'm not saying they look like... I mean, August actually, to be honest, I think August looks like it could be a really good month just because we still have high levels of negative, bearish sentiment in the stock market. A friend of mine sent me something today where August puts... open interest on puts on the SPY. That's the S&P ETF. The open interest is twice as large. It's like 2 million to 1 million for the August puts. So you got this embedded short position in August, and you're going to have a big, powerful fiscal month in August. So I think August we could get a pretty good pop, and then we go into September, and then mid-September we're going to get hit again with a quarterly corporate tax payment, and then, you know, the midterms after that, and October's usually seasonally a bad month. So, but you know, we'll talk about that when we get there. I think right now we're still good. We could get a little pullback now, a little turbulence now with the ECB. And again, next week, Fed on Wednesday, 75 basis points still priced in. That's going to be an interesting meeting because originally, what was it, last week, it popped up to an expectation of 100 basis points, a full percentage point, after the CPI print came out, and then kind of cooled off a little bit on that. So we'll see. I mean, a 75 basis point, that's going to be interesting because the market reaction could very well be, hey, that's not enough. We need to go more. So next week could be a little turbulent as well. Anyway, that's it for today, folks. If you want to get a copy of my MMT Trader, remember I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I use them to trade and invest in the markets. Educate yourself, get informed. Then, you know, it takes the fear out. Takes the fear out of the game. Knowing things, understanding what's going on, as opposed to just being in the dark. And being in the dark can make you very fearful because you know how the headlines are. You know how the stories are always slanted to the negative. Always slanted to the negative. And doomsday and terrible things are going to happen. So get informed. All right, bye.